You just watched silver drop like a rock, and I'm willing to bet your social media feed is flooded with doom and gloom right now. Everyone's screaming that the silver rally is dead, that it was all just hype, that you should have sold at the top. But here's what nobody's telling you. This crash had nothing to do with silver becoming less valuable overnight. It had everything to do with a rule change that happened behind the scenes while most people were sleeping. And if you don't understand what really happened today, you're going to make the wrong decision at the worst possible time. I'm going to walk you through exactly what caused this drop, why it keeps happening to silver specifically, and most importantly, what you need to watch next, because the story is far from over. But before we get into it, do me a quick favor. Hit that subscribe button right now. I know, everyone asks for it, but here's why it matters for you. The next time something like this happens, and trust me, it will happen again, you're going to want to know what's really going on instead of getting caught in the panic. So subscribe, turn on notifications, and let's get into what actually happened today. Silver didn't crash because someone found a massive new mine. It didn't crash because solar panels suddenly became obsolete, or because electric vehicles stopped needing silver overnight. Silver crashed because the Chicago Mercantile Exchange, the CME, increased margin requirements on silver futures contracts. Now, if that sounds boring or technical, stay with me, because this is where the real money gets made or lost. Let me break down exactly what that means and why it matters so much. When you trade silver futures, you're not actually buying physical silver. You're buying a contract that represents thousands of ounces of silver, but here's the catch. You don't pay for all those ounces up front. Instead, you post what's called margin, which is basically a deposit or a performance bond. It's the exchange's way of saying, prove to us that you can handle the volatility in this market. Now that margin requirement isn't fixed. The exchange can change it whenever they want, and when they increase it, everything changes overnight. Imagine you went to bed last night with a position that required $10,000 in margin. You wake up this morning, and suddenly that same position requires $15,000. If you don't have that extra $5,000 sitting in your account, your broker doesn't call you for a friendly chat. Your broker doesn't give you time to figure it out. Your broker liquidates your position immediately at whatever price the market is trading at in that moment. And here's where it gets ugly. When thousands of traders are getting these margin calls at the exact same time, they're all forced to sell at once. That's not price discovery. That's a stampede. This is what happened today. Right as traders were coming back from the holiday weekend, right when liquidity was already thin because we're at year end, the CME raised margin requirements. Leveraged long positions got hit with immediate margin calls. Traders who were betting on silver going higher suddenly owed more collateral than they had in their accounts. Brokers started force liquidating positions across the board, and because everyone was selling at once, there weren't enough buyers to absorb all that selling pressure. The price didn't gradually decline, it fell off a cliff. And that cliff-like action is your first clue that this wasn't a normal market move. Let me paint you a picture of how this cascade actually works, because understanding this is critical. The price starts dropping because of the forced selling. That drop triggers stop-loss orders that other traders had set. Those stop-losses become market sell orders, which pushes the price down further. That lower price triggers even more margin calls on traders who were barely hanging on. Those new margin calls force even more liquidation. It's a self-feeding spiral that does not stop until all the weak hands are completely flushed out of the market. And in futures markets, this can represent an absolutely massive amount of paper ounces trading in minutes, even though not a single physical ounce actually changed hands. Now here's something most people don't understand. The futures price is the benchmark price that everyone sees on their screens. That's the price that gets quoted in the news. But that futures price can be violently manipulated by these margin events, even when the actual physical silver market hasn't changed at all. You can have a situation where the chart is screaming downward while real-world demand for physical silver stays completely firm. That's not a contradiction, that's just how the structure of this market works. So let's talk about the physical side, because this is where things get really interesting. After a crash, like today's, I always check what's happening in the physical market. Are coin dealers dropping their premiums? Are bars suddenly flooding the market? Are wholesalers desperate to move inventory? Because if silver truly became less valuable overnight, you'd see desperation in the physical market. Dealers would be undercutting each other trying to dump product. But that's usually not what happens. More often than not, premiums stay firm or even widen. Dealers hold their prices. Inventory gets tighter because smart buyers rush in to scoop up metal at discount prices. That divergence between paper price and physical reality tells you everything you need to know. This wasn't the world rejecting silver. This was leverage getting purged from the futures market. And here's why that purge actually matters. When leverage longs get flushed out like this, the market transfers ownership from weak hands to strong hands. The weak hands are the leveraged traders who can be forced out by a margin call. The strong hands are the cash buyers, the long-term holders, the industrial users, and the physical accumulators who have the capital to step in during panic. So yes, Today's crash was violent and scary, but it's also potentially constructive because it clears out the unstable positions that could be forced out again later. It's like the market shaking out everyone who doesn't have staying power. Now, before we go further, I need you to do something. Drop a comment below and tell me, do you think these margin hikes are just about risk management? Or do you think there's more to the story? Because I want to hear what you think. And honestly, reading the different perspectives in the comments is one of the best ways to learn how this market really works. So comment below and make sure you read through what others are saying too. And let's talk about timing, because the timing of these margin hikes is never random. This increase hit during a year-end period when liquidity is naturally thinner. Banks are winding down for the year, traders are on vacation, trading desks are running with skeleton crews. In that environment, the same amount of forced selling hits way harder than it would during normal market conditions. It's easier to trigger stop losses. It's easier to create a cascade. And it's harder for buyers to step in fast enough to stabilize things. Coincidence? Maybe. But it's a pattern that keeps repeating, and patterns matter. Here's something else you need to understand about how margin calls work. They don't hit everyone equally. Big institutions, major banks, hedge funds, they can post collateral in minutes. They have credit lines. They have treasury departments. They can move millions of dollars with a phone call. But smaller traders can't do that. Retail traders definitely can't do that. Regular people can't wire fresh capital instantly, especially during a holiday period when banks are closed or moving slowly. So the market doesn't liquidate everyone fairly. It liquidates the least liquid players first. That's why these events feel so unfair, because structurally, they are. The big players get to stay in while the small players get forced out at the worst possible prices. Now I want to take you through some history, because silver has taught this exact same lesson multiple times, and most people never learn it. Let's go back to 1980. Silver goes parabolic. It's making headlines everywhere. And right as it's approaching its peak, what happens? The rules change. Margin requirements get increased multiple times in a short window. Buying power gets restricted. The most exposed traders get wiped out. The rally breaks, and the story becomes a cautionary tale about greed and speculation. But the real mechanism was mechanical. They changed the terms, and that forced the exits. Fast forward to 2011. Silver surges again. It's running hard, making new highs. And what happens? Margin requirements get raised repeatedly in just a few weeks. Each hike forces some traders out. Each forced exit adds fuel to the next leg down. It wasn't one sell-off. It was a sequence of squeezes, each one building on the last. And now, late 2025, we're watching it happen again. Silver runs into the mid-80s. And then right as everyone's coming back from the weekend, margin requirements get increased. The market gets squeezed. The move reverses hard. Same playbook, different decade. Now, I'm not here to throw around conspiracy theories, but I am here to talk about incentives, because incentives drive behavior. If you're a major institution and you're caught short in a market that's rallying hard, that rally hurts you badly. Every point higher increases your losses. A margin hike that forces long liquidation, that relieves pressure, it creates breathing room. It gives you a window to cover your short position at better prices. That's not conspiracy. That's basic market mechanics and human nature. When you're under pressure, you want relief, and margin hikes provide that relief. So ask yourself this question. When a wave of forced selling hits the market, who benefits first? The forced sellers are losing control. They're selling at whatever price they can get. The buyers with cash are gaining control. They're picking up positions at discount prices from desperate sellers. That's how markets work during these forced liquidation events. It's a transfer of wealth from those who don't have staying power to those who do. Let me give you a forensic breakdown of how you can tell this was a margin event and not a fundamental shift. The key clue is speed. Real fundamental changes don't happen in 15-minute avalanches. Physical demand doesn't evaporate during a coffee break. Mines don't triple their output before lunch. But paper markets can move that fast because paper represents claims, not physical metal. Claims can be created, traded, and dumped at the speed of algorithms. That's why futures prices can drop sharply without any meaningful change in the real-world supply and demand picture. Here's what typically happens during these margin flush events. The paper price drops. Headlines scream. Social media goes into panic mode. But then you look at the physical market. Coin dealers, bullion dealers, wholesale premiums. And they often don't follow the same pattern. Sometimes premiums actually widen. Sometimes dealers hold their prices steady. Sometimes inventory tightens up because buyers rush in to grab metal at what they see as discount prices. That divergence is your signal. It tells you that this wasn't the world rejecting silver. It tells you that leverage got purged while physical demand stayed intact. And this matters because it changes who's left holding exposure after the dust settles. Leverage is fragile. It's incredibly powerful on the way up because it amplifies your gains, but it shatters when the rules tighten because it amplifies your risk. When leveraged longs get flushed out, ownership transfers to cash buyers who don't have margin calls to worry about, long-term holders who are thinking in years, not days, industrial end users who need the metal for production, physical accumulators who are building positions for the long haul. That's a healthier foundation for the next move up, if it comes. So here's my question for you, and I really want you to think about this. Was today's drop a trend change, or was it a purge before the next leg higher? Because here's the thing, the purge doesn't fix the underlying fundamentals. It doesn't change the supply and demand equation. It was purely a rules event. So if the fundamentals haven't changed, what we're really talking about is timing, not direction. And that's a completely different discussion. Let's talk about those fundamentals for a second, because this is what actually matters in the long run. Silver is not just a monetary metal or a speculation vehicle. It's a strategic industrial input that's absolutely critical to modern technology. Solar panels use silver for conductivity and long-term reliability. You can't build efficient solar panels without it. Electric vehicles use silver in power electronics, battery contacts, and charging infrastructure. Data centers use it in connectors and high-performance components. The electrical grid modernization that's happening globally uses silver in switching and control systems. This demand isn't theoretical. It's embedded in the hardware that's being built right now. Now let's look at the supply side, because this is where things get constrained. Most silver supply doesn't come from primary silver mines. It comes as a byproduct of mining other metals like copper, zinc, lead, and gold. That means silver production doesn't respond quickly to price increases. If the silver price doubles tomorrow, it doesn't instantly double mine supply. The pipeline is incredibly slow. Permitting takes years. Capital expenditures take years. Ore grades are declining globally. Political situations intervene, so deficits matter a lot. When the world consumes more silver than it produces, inventories get drawn down. And when inventories get drawn down, the system becomes fragile. In a fragile system, paper events like today become even more violent because there's less cushion to absorb shocks. Now add in geography and policy, because silver doesn't exist in a vacuum. Large portions of refining and manufacturing capacity are concentrated in Asia. Large portions of industrial demand are in Asia. When physical metal flows toward end users in those regions, it stops being available to satisfy paper promises in Western futures markets. And if major exporting countries tighten export rules or prioritize their domestic industries, global availability can tighten even further. That doesn't show up immediately in a futures candle on your screen. It shows up later in delivery stress, higher premiums, and inventory drains. This is why silver can look calm on the surface while being incredibly tense underneath. So let me address the question everyone asks after a day like today. Does this crash mean the silver rally was fake? Absolutely not. It means the rally was leveraged, and leveraged rallies are vulnerable to margin shocks. That's not a bullish or bearish statement by itself. It's just a feature of how this market is structured. The real question is, what happens after the leverage gets shaken out? And that depends on whether physical demand remains strong and whether inventories continue to tighten. Those are the signals you should be watching, not the hot takes on social media. Here are 4 specific signals that matter way more than today's candle. First, physical premiums. If the paper price drops, but premiums on physical coins and bars don't drop or even widen, the physical market is telling you that metal is still wanted. Second, inventory levels at major warehouses and exchanges like COMEX. Not the rumors or the speculation, the actual reported ounces. Are they draining, staying steady, or rebuilding? Third, delivery behavior. Are more contracts standing for delivery? Are traders rolling contracts forward or demanding physical metal? Delivery demand is where the paper story collides with physical reality. Fourth, global price alignment. If different regions are pricing physical silver higher than US futures, arbitrage traders will try to close that gap. Arbitrage is what keeps distortions from lasting forever. Now, let me get practical about what today teaches you about risk, because this is critical. If you are trading leveraged, you just learned the most expensive lesson in commodity markets. You can be completely right about the fundamentals and still get destroyed by mechanics. The market can force you out before you get proven right. That's the harsh reality of leverage. If you were holding physical or trading without leverage, you learned a different lesson. Volatility is just noise unless it actually changes the underlying supply and demand picture. And today's move didn't change that picture at all. This brings us to the psychological warfare that comes after events like this. The narrative flips instantly. Bubble popped. Speculators washed out. Top is in. Silver is dead. You'll see articles and posts speaking with absolute certainty because certainty sells, but that certainty is usually fake. Markets don't work in straight lines, and margin events don't rewrite fundamentals. So don't anchor your thinking to one day of price action, especially when you can point to a clear mechanical cause. Instead, anchor to the setup. Did today's margin hike create more silver in the ground? No. Did it reduce solar panel production? No. Did it erase industrial demand? No. It changed collateral rules for futures traders. That's it. If the fundamental setup is unchanged, the question becomes timing, not direction. Now, what should you expect next? First, expect continued volatility. After forced liquidation events, markets often whipsaw. They bounce hard, then dip again. They test everyone's nerves. They hunt for stop losses. They punish anyone who thinks one move means certainty. Second, expect attempts to shake confidence, because right now, confidence is the real commodity being traded. And third, expect opportunity to appear where fear is most concentrated if, and only if, those physical signals I mentioned stay tight. This is where patience becomes an edge. The majority of traders are emotional, over-leveraged, and reactive. They sell at the lows because the chart feels like pain. The disciplined buyer does the opposite. The disciplined buyer watches the constraints, not the candles. Let me be crystal clear about something. I'm not telling you what to buy. This is education, not personal financial advice. Your financial situation is unique to you. But I am telling you what today actually was. It was a rules event. And rules events are where silver separates amateurs from professionals. Amateurs think price equals truth. Professionals understand that price can be pushed around by market structure, especially in a relatively small market like silver. Silver is small compared to other commodity markets. That's why it's so explosive. In small markets, it doesn't take much forced selling to smash the price, and it doesn't take much real buying to send it flying back up. That's the nature of the beast. Here's your clean summary of what happened. Silver fell today because the CME raised margin requirements, forcing leveraged long positions to liquidate. The move looked dramatic because thin year-end liquidity amplified the cascade effect. The move did not change the fundamental supply and demand dynamics. The move exposed the fragility of leverage in this market. And the next chapter will be written by those physical signals I outlined. Premiums, inventories, delivery behavior, and global price alignment, not by the loudest headline or the most dramatic chart. Now, if you found this breakdown valuable, do two things for me. First, smash that like button because it tells YouTube to show this video to more people who need to understand what is really happening. Second, share this video. I'm serious. Share it with anyone you know who trades silver or metals because most people are getting fed panic and misinformation right now. They need to understand the mechanics behind what they're seeing. So share it on your social media, send it in group chats, help spread actual education instead of fear. And look, I get it. Days like today are tough emotionally. Watching your portfolio drop in minutes is never fun. But this is exactly when you need to step back and think clearly. This is when you need to separate mechanics from fundamentals. This is when you need to remember that margin events are temporary rule changes, not permanent reality changes. The big money isn't made by panicking with the crowd. It's made by understanding what's really happening while everyone else is losing their minds. So stay sharp. Watch those 4 signals I gave you. Don't let one day of forced selling rewrite the entire story in your mind. And remember, these rule shifts rarely happen just once. History shows us that. So if you want to be prepared for the next time this happens, and there will be a next time, you need to be subscribed to this channel. You need notifications turned on. Because the next margin hike, the next forced liquidation, the next panic-inducing headline, I'll be here breaking it down for you in plain English so you can make informed decisions instead of emotional ones. One last thing before we wrap up. Drop a comment and tell me, after watching this, do you see today's crash differently? Are you more concerned or less concerned about silver long term? And what signals are you watching most closely going forward? I read every comment, and I love seeing how you're all processing this information. Plus, the more engagement this video gets, the more people YouTube shows it to, which means more people get educated instead of panicked. The market is a battlefield between those who understand structure and those who react to price. Today, tested which side you're on. Now you have the information to be on the right side next time. So subscribe, hit that notification bell, like this video, share it with others, and I'll see you in the next breakdown. This is Money Aftermath, helping you understand the real story behind the headlines. Stay informed, stay rational, and stay ahead of the crowd.